All right, great. So I asked Armando to come on. Armando's got a office over there in Covina, Downey, and has, come on here in the past, talked about some different things in the mortgage market, things along those lines. And I figured now would be a great opportunity to just have a little bit of a mortgage conversation about what's going on as rates are going up. And then there's this new program that came out that a couple people have asked about with the 0% interest for first-time home buyers or whatever the case may be. So I asked him to come on and kind of bring us up to speed and shed some light of what's going on in the mortgage world. And so that way we can be a little bit more knowledgeable about what's happening. So I appreciate, Armando, as always your service and helping out our agents and things along those lines. So appreciate that, buddy. So let's dive into this. I want to start with this program because I've gotten a few different questions about it. What is this new program for first-time buyers that's out there right now?
Yeah, it's pretty popular. Thanks for having me, Robert. I always appreciate you guys supporting me, and thank you all for listening to me. So this new program, it was on TV apparently because everybody's calling, right? I'm sure you guys are all getting clients who are calling or even old clients who didn't buy. And essentially what it is it's a down payment assistance program through the state of California where it's a forgivable loan. So it's pretty popular. And the way it works is they'll lend you up to 10% of the sales price. So if you buy a place for $500,000, just as an example, 10% falls off every year. So if you sell it or refinance it in year one, you'll pay back 40% of it, year two, 30%, and so on. The difficulty that we're running into is that they have income limits. So you need to be at 80% of the median income for the area that you are looking at homes. And unfortunately, that the income has not caught up, or the limits have not caught up with home prices, right? So just as an example, one that we looked at, the zip code was 90011, so it was right in the in the middle of South LA. The median income for that neighborhood was $62,000, but the median home price for that neighborhood is $590,000. So unfortunately, $62,000 is just not enough to qualify for a $500,000 loan, even with 10% down. So the challenge that we're finding is that people who make under that median income don't actually qualify for the houses that we're trying to put them in LA County, where we've had some luck. If any of you work the high desert, I have two people that have qualified for this program up in the high desert, where the sales prices are a little lower. I think up to $320,000 is the highest one. So it's a great program. It was written with great intentions. I just think it's a tough market to do that in, just because we're so limited by that income, if that makes sense. Does anyone have any questions on that? I know there's a lot of information. No, I explained it well. Huh?
So I guess here's my question is, can you get a down payment assistance offer accepted? I mean, are you getting that at all?
I'll tell you, in the last 2 weeks, I've seen a little bit of a shift in what we're doing. And you're absolutely right. A year ago, I wasn't really taking on the down payment assistance crowd because it was very competitive. The last 2 weeks, for me personally, I've seen offers come back with a single counter offer. You guys remember those before we had multiple counter offers on everything? And I've been able to get a couple into escrow with down payment assistance in the last 3 months. I think the last 30 days or so, it's become a little bit easier. I believe that there's less competition. There's definitely not a buyer's market, but I think we're not getting 30 offers per listing. I think it's a little bit more, like 5 to 10 offers. Is that what you're seeing, Robert?
Depends on the market. I mean, we have some areas and some price points that are getting definitely less offers, and we still have some areas where they're getting $40,000, $50,000 above list price. So it really depends on the area right now.
Understood.
So that's what makes it very interesting. Okay, got it. So so that's that down payment assistance program. So it's 0% interest, but there's the income limits that are going to make it somewhat difficult.
Correct.
I have a quick question.
Yes.
When you say 10% down assistant, what does that mean? Does that mean that the buyer doesn't have to have any money down, and the first 10% is from the government for the down payment?
Correct. That's essentially how it would work out. It would be the equivalent as if the buyer came in with their own 10% down. Some of that goes to closing costs, right? So it actually equates to about a 5% down program, but the buyer comes in with no money out of pocket because they're taking the 10% from the program. 5% of that goes to down payment, and then some of it goes to closing costs. There's some fees involved, and there's usually points in those because it's a bond program. So some of it gets eaten up in the closing costs for sure. But for someone who hasn't been able to save a lot of money just for whatever reason, it's a good way to get their foot in the door. To Robert's point, assuming that you can get the offers accepted, right? But if it's a tenant that's buying your listing, it might be a little bit easier because they have a relationship with the seller. Those are the ones that we've been able to do. So things like that, where there's already a relationship, is easier than if you're in the open market writing offers with other potential buyers.
There you go. Good. If you have questions about anything, feel free to unmute yourself or put it in the chat box, because we're really just going to have a conversation here. So he's here to help answer any questions that you might have. So on that same point then, kind of similar, Armando, FHA, VA, I hear from people, I can't get an FHA, VA accepted. I hear from other people that they're able to get their FHA, VA accepted. I mean, what are you seeing? Are people able to get those more than previously, or are you still seeing struggles with that?
You know, I've seen more FHA loans in the last 60 days, and I probably saw all of last year. In fact, we just closed on a condo that was not FHA approved, and we did an FHA loan with a single unit approval. Actually, it was with someone at Century 21 Masters, and that just closed maybe a week ago. So in the past, if there was a condo that's not FHA approved, it's plastered all over the place, no FHA condos. This particular listing agent accepted the offer knowing that it was an FHA loan, and even helped us get that FHA single unit approval done for that complex. So it worked out nicely. So I am seeing it a little bit better. I think that agents do a good job. When the buyer's agents do a good job in building that relationship with the listing agent, it makes it easier. And I feel that that's how we got this one.
So explain that a little bit more, how to get an FHA approved that's not an FHA condo.
Yeah, so if y'all ever sold an FHA condo, condos have to be approved through the FHA or through the VA. Otherwise, normally we can't finance them with an FHA loan. But about a couple years ago now, we just haven't done a whole lot of them. The FHA came out with, they used to call them spot approvals before, where we can take one unit in the complex that's not approved and fill out some paperwork and get it approved. They made the process actually a lot easier. But if you've never done one, it's kind of a little scary, right? Because you don't know if it's going to go through or if you're going to be able to meet the guidelines. But we realized through this one, it wasn't that hard. So if you do have a condo that you're listing and you want to open the doors to FHA buyers, I'd love to talk with you about it and see if we can get it approved, even as a single approval. But it does make it a lot easier. But I guess the point of that was where the agents before would just reject our offers for being FHA, this particular agent at least was willing to work with us, even knowing that we had an extra hurdle to jump through, you know? So I do believe that it's getting easier, but I think that if you're representing the buyer, it's really important that you build that relationship with the listing agent before the offer goes in and really understand what they're looking for.
Okay, explain that. You've explained that before, but I think you explained it very well in terms of what is the client looking for.
Yeah, Melinda, who works on your team, was the first one that really put me onto this. So I always give her credit.
She doesn't need any more credit. Just take it for yourself.
I came in as the eager lender one day saying, I can close in 15 days. And she says, the client doesn't want to close in 15 days. They need a 60-day escrow. So you're doing this wrong. And I realized that day that it's not always about closing fast is what's important to the seller. Sometimes sellers want to close fast, but sometimes sellers are relocating. They need 90 days. They might want a rent back for 30 days, or they might want, something that will make their life easier. So I think that's the way we want to approach them, in a way of what's important to the seller rather than I want to close in 15 days or 20 days or whatever that, that fancy pre-approval says from the lender. And ever since I started doing that, I've found that the listing agents actually give me a lot of information, and they've even told me when I have to go higher on the offers, and then I just relay the information to the listing agent. So they teach us to ask questions. Just ask as many questions as you can, and then use it, right?
Right. So I want to just go over that point again for everyone, because I think this is really important when you're working with a buyer. It's obviously very tough to get the offer accepted. Ask the listing agent what is important to the seller. What kind of offer is the seller looking for? Because sometimes we just think, to Armando's point, it's, well, let's write an offer to close in 21 days and $50,000 above list price, or waive the contingency and waive that. And maybe the seller, to his point, is going, well, I don't really want to close in 21 days. It would be really great if someone was open to a 60-day escrow. Or you go in and you waive all these inspections and you waive this contingency. And then maybe the seller says, I don't care about those contingencies. I just want X. So ask the listing agent before you write an offer, what's important to the seller? What kind of offer are they looking for? So you can then customize the offer to what they want. Or maybe it's the opposite. Maybe they say, well, what's really important to them? It's not so much the money. It's, can you actually close in 14 days? So then you can go to the buyer and say, look, if we can do this, then we got a shot. So I think that's a very important point that I wanted to make sure we went over. Okay, good. So let's jump to really what is the big discussion in the mortgage world, Armando, with the rates. So what's going on? What are you hearing? Where are we going with this? What's the latest intel on that?
It's definitely something we've never seen before, right? We've seen interest rates climb about 2% in a matter of 30 or 60 days. It's just super fast. We've also seen inflation at the highest rate that we've seen in like 40 years or some crazy number like that. So what I believe is they'll continue to go up a little bit here as inflation continues to climb. And just based on like year over year numbers, I believe that inflation is going to peak around September or October of this year. And if that happens, if the trend does what it's done in the past, we should see inflation start to kind of go down and hopefully take the rates with it. Inflation and mortgage rates are kind of go hand in hand. Anytime there's bonds don't like inflation. So the more we see this, the higher we'll see the rates going. But again, I do believe that there will be a peak here as long as we get everything kind of back on track. The supply chain disruption caused a lot of this. China being partially shut down right now is helping with our gas, but once they open up again, they need a lot of energy. There's a lot of people in that city that's shut down right now. So I think we'll probably see some gas prices going up, which will hurt inflation a little bit more in the next couple of months. But I think that there's light at the end of the tunnel. I think September or October we'll probably see the peak. One good thing that I'm seeing, and I'm sure you guys are as well, 3 weeks ago when clients would call, we would tell them the rates were 5.25. They would freak out a little bit. But today when clients call, we tell them rates are 5.5. They just know that rates are higher now. So I think the sticker shock is going away, and that's potentially what caused like a couple of weeks of what happened here. But as I sat at an open house this weekend and we had really good clients coming in. They all seem to be pretty motivated and qualified and realistic with what they were looking for. So I think the media, at least, I always kind of rag on the media a little bit because they're so negative, but I think the media has done a good job in telling the world that rates have gone up. So it's made our job a little bit easier, at least right now, for once, right? Rather than the other way.
Very good. So what are you hearing anything about what they might peak at?
That's hard to tell because if you're watching it, like those charts are really weird. Like one day we have a huge swing for the upside and we think, all right, this is it. They're going to get better. And then the next day we have like a swing double the other way. That like the pendulum right now is really odd. We have seen some rates in the sixes now. I hope they don't get there, but I read a report that said we'll probably hit the high sixes before we turn around. So yeah, I hope that doesn't happen. But again, I think it's only like 3 or 4 more months of this before we start seeing some relief is what I believe, at least. Hopefully I'm right.
So let's take and I apologize. I didn't ask you to do these numbers beforehand, but on a rough scale, let's say a $500,000 mortgage or whatever number you want to put. If the rates increase 1%, what does that typically equate in terms of monthly payment?
Yeah, that's a great question. So if you're at 5%, I'm sorry, at 1% difference, so if you go from 3% to 4% on a $500,000 loan amount, you're talking about $5,000 a year in payment. So the best example I have is I have a client like this. We pre-approved them at 3%. The rate went to 5%. His loan amount was $600,000. So 2% of $600,000 was $12,000 a year, which means his payment actually went up $1,000 a month. And he still closed on it, but a lot of clients have decided not to, or maybe they just can't qualify anymore when we see those swings.
So I bring that up because you're right that I think a lot of people have kind of, at least from the conversation I've had, is they've kind of gotten used to, hey, look, the 5% is here, it's here. But if a rate goes up to 6, potentially, that's another 1%. So the message we need to get across to people that are buying is that number is that, gosh, if the rate potentially goes up to 6%, that's another 1%. That could cost you another $5,000 a year. You know, and if it's a $800,000 mortgage, and it's, it's $8,000 a year. Let's factor that over 4 or 5 years. Factor that over 10 years. See, I think what we need to do to explain to some of these buyers, let me kind of walk through this. And Armando, you might be doing this with your clients. They say, well, okay, I buy now at 5%. Well, I'm concerned about the prices dropping. Okay, well, what do you think the price might drop? Well, what if the price drops $30,000? Okay, well, what if the rate goes up 1%? $700,000 at 1% is $7,000 a year. And let's say you keep this loan for 10 years, that's 70 grand. Even if the price dropped $30,000, it's still better than losing $70,000 in payment. Does everybody understand kind of how we're calculating this math? Is everyone confused now that we've got numbers involved? Nobody told me there'd be math, Robert. Okay, so I appreciate the honesty. So let me try to walk through this, and Armando, help me out here if you can explain this a better way. Buyer says right now, okay, I can buy the house. I can get a $700,000 loan. My loan amount is $700,000. But I'm concerned that if I get the loan now, prices might go down. Okay, we hear this. So we say, okay, great. Well, what do you think prices might go down? Well, they might drop 30 grand. Okay. So if prices drop $30,000 and you buy, then you save $30,000, good for you. But what if at that same time, the interest rate goes up from 5 to 6? You still get the house, you save the $30,000, but you're adding $7,000 a year to your monthly payment. A year, not a month, a year. And let's say you keep the loan for 10 years. That loan now costs you $70,000 more because you waited as opposed to getting it now. So even though you save $30,000 on the purchase price, it costs you $70,000 in the loan. I might have confused everybody even more. Okay. But this is the conversation piece we need to have, however we need to articulate it, however it makes sense to you. This is the conversation piece you need to have with some clients, because I think there's a lot of buyers out there that don't look at the big picture. They look at the price might be going down a little bit, but as Armando's saying, the interest rate might go up another %. You know, we're not dealing with $150,000 homes. Well, some of us aren't dealing with $150,000 homes. We got some mobile homes going right now. Okay. All right. Good. Questions on any of that stuff with the interest rates or things along those lines? Okay. So the other question I had on that, Armando, is are you seeing more and more 7-year, 10-year ARMs because the rates have gone up a little bit where people are just trying to lock in at lower rates for 10 years?
They're starting to bring them back, but honestly, the margins are really funny. So what's happening right now in mortgages, and you guys may have noticed already, is we're seeing a lot more points. Almost everything that we're doing has points attached to it. And the reason why is when we sell a loan in secondary, the servicer who buys the loan for us is buying the loan and paying us for the loan up front, and they're going to recover their money by charging interest every month. But what's happening right now is they realize that the rates are at a place where it's going to change, and it's going to change in about a year and a half is at least what I believe and what I've read. So they figure that most of these loans are going to pay off early, right? They can only recover their money if they're charging 4% interest and they pay $20,000 for a $500,000 loan. It's going to take them a little while to recover that, at least a year, where they just break even, but they're not in the business of breaking even. So what they've done right now, and we see this a lot with adjustable rates, is they've made it very unappealing to take a rate. So you might get an adjustable rate that's at 3.5%. They might charge you 5 or 6 points for it, because what they want to do is they want to make all that money up front so that they don't have to wait 2 years to recover it, because they believe a lot of these loans are going to pay off early, right? So it's interesting to see that the investors are doing that in secondary, and we see it when we get those sheets. But they're seeing the same thing that we're seeing, right? They believe it's going to peak and it's going to start to go down. And a lot of those adjustables will pay off when when interest rates start to go down. So we are seeing people ask for them, but what we're noticing is that it doesn't always make sense to take them. Now, on the bigger loans, like the jumbo stuff and some of those like non-QM programs, they were written in a way where they're conducive of adjustable rates, right? So they're more appealing to people. So those are easier to work with. But as far as conventional loans and FHA loans go, the government just kind of revamped the way they calculate or they determine adjustable rates. But again, just the investors on the secondary market don't have an appetite for them right now. So it's just not pretty. Someone asked to explain points. So generally, when you take a mortgage, you hear people ask if you paid any points. Think of 1 point of a mortgage as 1% of whatever the amount is that you're borrowing. So in the example that Robert gave us earlier, on a $700,000 loan, 1 point would be 7,000. So it's just 1% of the amount you're borrowing. We're all good at like percentages here, right? 1, 2, and 3%. So think of it as just 1 point. And the way points normally happen is the buyer can elect to pay a point to buy down the rate. So just as an example, let's say that today's rate is 4%. If the buyer elects to pay 1 point, he might get a rate, or she, of 3.75 because he's prepaying that interest. So paying 1 point would get him a lower rate for the life of the loan. We can also go the other way. Have you guys ever heard of lenders saying that they can cover closing costs through a lender credit? So in that example of the interest rate being at 4%, we can also say, hey, the buyer will pay an interest rate of 4.25%, but we'll give them a lender credit of 1%, which is $7,000, in order to cover their closing costs as part of the process. That's kind of how points work, kind of like the old number lines in third grade, right? The 0 + 1 + 2, and then the negatives on the other side. And then Lynn, if you need a more detailed explanation, I'd be happy to jump on a phone call with you, or anyone for that matter.
Thank you. That was a good explanation. Very good. Okay, cool. Again, if you have questions, feel free to unmute yourself, put it in the chat box. So here's
Armando.
something that I've been fascinated about recently. What's the minimum for someone that wants to put 5% down? How high of a loan amount can they go? Again, assuming that all the credit and income works.
Yeah, well, in LA County and Orange County, we can borrow up to 970 with as little as 5% down. In fact, 970 with 3.5% down if you're doing an FHA loan. So you could buy a house for $1 million and put as little as 3.5% down.
Okay. I wanted to get that point across because when you explained that to me, first of all, you did that a couple years ago when it was like 750 or 800,000. I was blown away. And then now it's 970, because I'm still in the, dark ages where it's like 417,000 is the conventional loan limits. And you got to put 5% down for that. So a 5% down, you can actually borrow up to $970,000. Again, assuming everything else checks out.
Correct. Yes.
Okay. So that's really important, I think, for everyone to know, because when we promote calling condos, for example, or things like that, and they say, well, how can I buy a single family residence? I only have this much equity. I only have this. They can buy $1 million house with 5% down. Yeah. Now, again, they have to qualify everything else, but the point is, it gets you in the game. It gets the client in the game. That's what we're looking at, because let me ask a question. Do most people think if they're buying a house for $800,000, they have to put down like $100,000, $200,000? Is that what most people think? Yes or no? Yes. Yeah. So when you call people and they're thinking about selling, they're like, yeah, but I can't buy a replacement property. I don't have 100, 200 grand to put down, even if I did give my equity away. So they think they're not even engaged. Get them in the game. Well, gosh, if we could get you at least qualified, I think you might be surprised at what options you have. It doesn't cost you anything. Let's just get you in the game. To get the listings for the replacement properties, you got to get them in the game, because I think that's where we're getting stuck with a lot of buyers, is they think they don't qualify because the down payment requirements are so high. Now, again, they have to qualify. There's certain parameters, things like that. But I wanted to make sure we got that point, because I think if we get more people in the game, it's going to lead to maybe a couple listings here and there. So very, very important to at least get them approved. I think you're going to be very surprised at what they could qualify for. So now let's go to jumbo, Armando. So give me some ideas on jumbo. If I want 1.5, if I want 1.3, I mean, what are my down payment requirements? Because again, I'm still in the world of anything over $1 million is 20%. So what am I looking at with some of that stuff?
So up to $2 million, we can do as low as 10% down. And that's the lowest I've seen. I know there's a credit union that does a 5% down. I think we're going to have it soon. We don't have it yet, but I saw a memo saying that this month we're supposed to have it, but a jumbo program with 5% down. One thing that I'm doing a lot of right now is, if you have clients that are self-employed, or maybe they're investors and have a few properties already and just can't qualify for another loan, there's a couple of things that we do. We have a program that goes based off the income that the property generates, as long as it's an investment. They call it a debt servicing loan. So they look at how much rent comes in, they subtract the 25% vacancy. And if the numbers work out, your client doesn't need to show any tax returns or anything at all. They don't show any income. They're just qualifying based on the rental of the house. And those we can do with as little as 10% down, up to $2.5 million. So sometimes on the jumbo stuff that doesn't quite go, we can work something out on one of these programs. And we're doing a lot of the loans with bank statements. So people that are self-employed that don't quite show income on their tax returns, we can take their 12 months or 24 months of their bank statements and qualify them based on how much they deposit. And those go to 2 million as well. So a lot of the jumbo stuff, if there isn't a program, or sometimes they don't qualify for it the way the jumbo programs require them to, there's some pretty cool alternate programs that are coming out right now through the non-QM channel that I think are going to be pretty popular as these prices, go up, if they continue to go up. Probably not at 20%, but at whatever the normal rate of appreciation is, right? I think you're muted, Robert.
Right. So okay. So that was going to be my next question, because obviously we get that a lot, as I'm sure you do, stated income. So where are we at in that world?
So stated income, I don't have anything now. I think that one's kind of tricky because the government really doesn't like that. So like stated income stuff.
It's not about what the government wants, Armando. It's about what these clients want. Come on.
Right? Yeah, trust me, I wish we can do all stated income like we did in 2005, but it got us in trouble. But it was so much easier for us back then, right?
Right.
But I believe that there might be some that come out with some restrictions. There's some programs now where it's not actually stated income, but the client has to produce a profit and loss statement that's unaudited. So we may as well just state the income, right? Because the profit and loss, they put whatever they want on there and the underwriters take them. So I believe they'll become a little bit more flexible unless they're scared. And that's the tricky part with those types of programs. Like FHA and conventional loans, they're generally always there, right? Or we just believe they're always going to be there. But some of these specialty programs, when things get shaky, they pull out of the business very fast. And back in the old days when the market crashed in like 07 and 08, they would give us some sort of warning, right? They would send an email saying this program's being discontinued. You have 30 days to close out whatever you have, and life was good. Today, they don't really give us that warning. When they get rid of a program, they say effectively, immediately, we're not accepting any new submissions. So if you have somebody out shopping or someone who just got a contract in today and the bank doesn't take any new submissions, then we end up trying to scramble to find a replacement lender or a replacement program. So those make me a little nervous, but I think where we are right now, we should be okay based on what's going on. But if the market does get shaky, if it, for whatever reason, reverses and starts to go the other way, I think we'll see some of these programs kind of be discontinued like we saw. I don't know if you guys remember, but January, February, and March of 2020, a lot of these non-QM programs just fell out. Lenders didn't want them. The investors didn't want them because they didn't know what would happen with the market. So that's the only thing that makes me a little nervous about taking some of these. But I mean, that's the environment we're in, and I'll have to know where we are, I guess.
All right. Very good. Very good. Very good. Very good. I want everyone to know, this is my own personal opinion, which I don't give very often, but stated income loans, as frustrating as it can be for some of your clients, it's good that they're not around. Okay. It just is. So I know it sucks at times because, we miss out on some deals, but you might be responsible, but the majority of the world won't be responsible. And that's where we get into problems. All right. So there you go. All right. Questions. I've got more stuff, but anyone have questions? Armando, thoughts?
Armando,
yes,
this is Fred. The broad stroke in terms of the media output is saying that applications are plunging. In your specific business, the people that you're catering to, the agents, is that accurate? Because what I'm experiencing is I'm not getting 10 showings on a hot listing, I'm getting 5. I'm not getting 4 offers on a listing, I'm getting 1, possibly 2, to leverage one against the other. But the highly qualified, highly motivated buyers that can still afford it, that have cash reserves, are still in the marketplace. So again, the question is, are you seeing a decline in the number of applications that you are currently taking on a monthly basis? Absolutely.
I believe it's a little bit of a sticker shock, right? Where all the buyers coming into the world were expecting to see rates in the 2s and 3s. So when they saw the 5s, some people they have a hang up, right? They see the 5% rate and say, oh, I'm not going to buy because the rates are too high. But I think it's us as professionals, we have to really break it down to them and look, we're not going to see 20% increase in values, but if we see a 5% increase in values, it's better than the normal 2% is what the government expects. So to answer your question, Fred, yes, we have seen, I don't think it's plummeting. I think we lost a lot of refinances. I think refis over year, they're down like 70%. And of course, right, not too many people want to refinance their home from a 3% to a 5% rate. It just doesn't make sense. What they don't show in those statistics is that applications for home equity line of credits are at an all-time high. And what's happening is the people that stopped refinancing are going to banks and just getting HELOCs. And they're taking those HELOCs in order to do other investments. So I think in 1 week, I had 7 or 8 of my clients who called me to try to do a refinance. And in a normal market, they would have turned into an application. But rather than turning them into an application, I referred them to a bank who can do a HELOC for them and ultimately put them in a better position. So I think the media is very skewed. They want to show us like all the negative stuff. I think we're all expecting to see less refinance transactions and there's no inventory. Another thing that the media shows, and they do this every month, they say home sales are down. Well, home sales are down because there's no inventory. If we had 20 more homes on the market, we would probably sell 20 more homes. But they focus on the fact that home sales are down without really looking at why home sales are down. And they just have that headline for the consumer to see. So I always try to explain to the consumers the entire process of what's happening. so that we kind of get the fear out of their mind. But I think it's the media is definitely not helping our case right now.
I can tell you in the last 10 days, I've definitely seen a spike in the inventory from, let's just say, the city that I live in, the city of Whittier. It went from 61 on May 3rd. It's now at 90 as of today. So that's a 30% increase in, what, 17 days, 15 days, 2 weeks.
How does that compare to last year's spring market? Because it's my understanding that usually during the spring, we see an increase in inventory. Do you compare those numbers year over year?
You know, I can't specifically tell you what May was at last year, but we've been under 100 for at least since the beginning of the pandemic.
Got it. I'd be interested to see, because we all know that spring market brings inventory, right? And people are getting ready to get the kids out of school. And this is usually when it ramps up for us. So I wonder how much of that extra inventory comes from just the time of the year that we're in.
Hard to say. I'd like to think that people are pushing that panic mode and saying, hey, it's time to get this property on the market and get what we can while we can.
Perhaps. And we don't see the number of buyers that we had 6 months ago, right? Just taking over everything. So they might sit a little bit longer, I think.
Yep. I think it's a little bit of both. All right, good.
Last
good,
question.
Good.
What are the pros and cons of buying a $2 million house with 10% down and leveraging that much money with just 200 grand?
I guess it would depend on the individual, right? I'll tell you, I've never done a deal for $2 million with 10% down. Most of the deals that I've done that are big prices end up turning out to low loan amounts. Like the last one we had was a $2 million purchase and he put 1.6 down. So most of the ones that I've seen have a larger down payment, because that would be a pretty crazy payment, right? $2 million,
right.
Like $19,000 a month. But I mean, the program is there that will allow it. And I imagine that if they created the program this way, there might be a demand for it. I haven't seen too many of them, but my average sales price is still about $900,000. So I don't really spend a whole lot of time in the $2 or $3 million price range, to be honest.
Right. Thank you.
Yeah. Good to see you, Fred.
So to help answer that
Likewise,
question as
thank
well, Armando, I guess the pro of it is if they can afford the monthly payment, they can buy a $2 million house with only 10% down.
Yeah.
You know, so if you're willing to pay the monthly payment, but you really want a $2 million house and you don't have $400,000, $500,000, $600,000 down, you get an opportunity to get a $2 million house. The con is that the payment's going to be a lot higher because you're probably also going to have to pay mortgage insurance. And mortgage insurance on that type of loan is going to be pretty expensive. So your monthly payment's going to be quite a bit. But, you know, that's the pro and con. Do you want the house? Yes. This is the cost of it. Are you willing to do it? For some people, I'm willing to do it. Some people, no.
Yeah.
But it's there as what I look at some of this stuff as is, like I said earlier, it gets us in the game. I have a client, they really want to purchase a $2 million property. Guess what? As a real estate agent, I also want them to purchase a $2 million property. Okay. But they only have this much money down. Okay. It gets you in the game. I'm just trying to get in the game.
Can I add something to that, Robert?
Yes.
So Fred, I didn't understand the question, but another thing that can be a pro is if you take $1 million and invest it. I mean, the market's kind of funny right now, but historically, if you invested $100,000, you can yield in the S&P 500 8 or 9%. So if you're paying interest at 4%, I'd much rather pay 4% and have my $1 million yield me 8 or 9%, and ultimately I come out on top. So I have seen people leverage loans that way. That's an extreme example because we're talking about a large amount of money, but that would be one way to leverage it.
Very good. Very good. Other questions? So, Armando, one of my last questions here, trying to look on the positive side of life. Would you say that the people you are working with right now, because of the rising interest rates, because prices continue to rise, that you're pretty much only working with really qualified, really motivated people?
Yes, absolutely.
So the reason I bring that up for everyone is that if you have a buyer that's willing to go through the pre-approval process, they're probably pretty motivated to get something right now. So you find somebody like that, push, get them going. Whereas a year, 2 years ago, when rates were 2%, Armando, there was probably a lot of pre-approvals that never ended up buying anything, right?
Yeah, absolutely. I'm sure you
yeah,
guys
because
have
it's
seen
just
people
I just want
shop.
to see. I'm in the I want to see mode because rates are 2%, 2.5%. So as an agent, you might have a buyer that is getting pre-approved and you're chasing, and they don't know if they're going to do something. Right now, if they're willing to go get pre-approved, you got somebody. Go get them. Okay? Yeah. Go get them. Go push them. Very good. Good stuff. Good stuff. Armando, anything else you want to add? Anything else we need to know? Any other pitches you want to make?
No, I'm here. If any of you have any questions or you want to chat with me on anything, I put together a lot of events and lunch and learns and things like that. So if you're interested in getting the information for any of our events, we do client events through Zoom that I'll invite any agents to. You can watch them, and if you want to duplicate them, we'll help you. And then we do events for real estate agents as well here locally in San Dimas and Glendora.
There you go. So here's what I would encourage for everybody. We as an organization are pretty fortunate. We don't do in-house lenders and things like that. We have people like Armando. We have people like Barry who are really great lenders that are always here to provide service for us. I would encourage you to engage and ask questions and do things like this, because I'll wrap up with this. We've been talking over and over and over again. We hear it all the time. The prediction is that there will be less transactions in 2022 compared to 2021, correct? That's what we all hear, okay? When I hear that, this is just my mindset, doesn't make it right or wrong, but just hear me out. When I hear that, I hear this: I've got to get in the game with more people. If there's less transactions, I've got to get in the game. So utilize some of these people like Armando to say, what can I do to try to get in the game with another deal? I have an FHA buyer. There's not an FHA condo approval. He found a way to get the condo approved and get the buyer into escrow. That helped the listing agent as well because it got them a deal. So even if you're not representing the buyer, you have a seller and it's a condo that's not FHA approved. What can I do? Right? I got a buyer. They want to move up, but they're concerned about the down payment. Well, let's get them in the game. You can get 5% up to this point, 10% up to this point. I've got to get in the game more often. That's my mindset when I hear there's less transactions. So utilize the lenders to say, hey, what's going on in the market? What's happening? Right? He says interest rates could go up to 6%. How do I utilize that to the buyers and sellers even? Right? Because we use that affordability chart. You have $1 million property. If the rate goes up to 6%, Mr. and Mrs. Seller, that's another group of buyers that can't buy your property. Either can't or won't. So utilize this stuff to get in the game with more and more people. Some of them will not do anything, but it's just getting in the game, right? As Wayne Gretzky says, I miss 100% of the shots I don't take. I've got to get in the game. Very good. Very good. Other questions, comments, anything for Armando? I just posted his information in the chat box. So if you want to
on my personal cell number too. If you need to text me, you can text me there as well.
There you go. Beautiful. Armando, as always, I appreciate all that you do coming on here, helping us out with all this great information. I really wanted to get you on because there's just so much going on in the mortgage market. I wanted someone who, you've been on here before, done some stuff for things like that. So I wanted to get you on here, and I greatly appreciate that.
Thank you, Robert. I always appreciate the opportunity.
Yeah, no, absolutely.
One last question, Armando. I talked to another mortgage officer, loan officer, and he said there's a good chance of interest rates might hit 8% by the end of the year. Is that fact or fiction?
It's hard to say, right? I hope they don't. I read a report that said we might hit the sevens by the end of the year. It's possible. I mean, we've seen some pretty big swings in some days where we lose 80 basis points all in one day. So
well, if the present trend continues, we are going to see a slowdown.
Yeah, agreed. So I'm not sure. I hope they don't get to 8%, but I don't think that it would be impossible to get there.
All right. Thank you.
Yeah.
You know, on that point, and Fred brings up a good point here, is the fact that it's even a conversation is why we need to have that conversation with our buyers and sellers. You know, because that wasn't a conversation 2 years ago. No one was like, hey, do you think rates could get to 7-8%? It's like, well, that's a stupid conversation to have. But the fact that that's even a conversation, it's even a question, it's even potentially people that are in the know saying that kind of stuff, it makes it worthwhile to reach out to sellers and buyers and say, hey, look, no one's got a crystal ball, but these are conversations that are going on with people in the industry. So, you know, if you're looking to do something, we need to have a conversation. But you need to be able to articulate to both buyers and sellers what that means if rates did get to 7 or 8%. Because one thing I've learned in my years, and Armando, you could probably relate to this, there's a lot of people that think interest rates are just like mythical numbers. They don't really understand how it impacts things. You know, rates go up 7%. There's a lot of people that go, okay, like, I don't know what that means. You have to be able to articulate to a seller, if rate goes up 7%, this is what it means to you as a seller. This is what it means to you as a buyer. Okay, so I would work on that if I were you, and have those, be prepared to have those conversations sooner rather than later, because you want to catch people before they get to 7%. Because if you wait till 7%, you've lost it. They've got too many other agents that have already spoken to them. So have that now. All right, very good. Armando, again, I greatly appreciate it. Thank you. And if I haven't said so, thank you. Fantastic information. So
as we watch Armand Martinez change his shirt.
Yeah, look at man, he's working out over there.
Yeah, good muscles over there, buddy.
Sorry, guys. I totally didn't see that. I have a bacon